So, so here today with the CEO of Iteris, Joe Bergera. Um, I'll let Joe give the intro to the company, but just a little. I'll give a couple of valuation metrics first, which is my specialty. So basically, Iteris is trading at about 1 times EV to revenue now, which is really cheap for an industry leader like it is, and they have a fiscal 2027 plan to get EBITDA margins up to sort of 16 to 19%. So if you factor that in, it's trading about 5 times, that year's EBITDA. And once they sort of get to those numbers, I don't think the stock is going to be trading anywhere, near where it is today. So let me turn it over to Joe. Joe, just maybe just to start out, if you could describe Iteris's end markets, like the total addressable market, industry structure, and then we'll go from there.
Sure, great. And Jeff, thanks for having me on today. I appreciate it. So, yeah, Iteris, obviously, I think is a super interesting and super exciting company. Obviously, we're still a small public company, but as Jeff said, we're a market leader in, it's a highly fragmented industry or sector. And we refer to that sector as a smart mobility infrastructure management market. And you guys may be wondering, well, so what the heck does that mean? To try to boil it down to something simple that we can all kind of understand. We basically provide technology solutions that help the road infrastructure work better for the traveling public and then also for commercial fleets. And, we do this in a lot of interesting ways, and we'll kind of get into a little bit more detail as we, go through it today. But anyway, that market we participate in is comprised of 7 distinct categories. And, collectively, they represent, if you look at it like, the forecast calendar year 2026, total addressable market is about $8.3 billion. And again, we're really small. We've guided to about 172.5 million in our current fiscal year. But again, we're a really big player in this incredibly fragmented market. The categories in which we participate include managed services, software as a service, data as a service, platform as a service, mobility consulting services, and mobility infrastructure devices. And then those mobility infrastructure devices can be further deconstructed into a couple of categories, such as intersection detection sensors, connected vehicle sensors, and travel time sensors. The compounded average growth rate, this market is estimated to be about 8%. But there is some variation among the 7 categories that I mentioned. And then also the market is, highly fragmented. And so most of the industry participants operate in only a single category or maybe like even just a subcategory. And they typically participate in only like a certain geographic area. So as a result, the primary customers, which historically been state and local agencies, but as we're going to talk about, we're getting more and more exposure to potential, to actual private entities who are interested in this space as well. But anyway, state and local transportation agencies, because of the high degree of fragmentation, have ended up with these highly heterogeneous technology environments. In a lot of cases, they're comprised of many technologies that have been developed by companies, a lot of times local companies that are only marginally financially viable. And so that's creating a lot of risk and a lot of opportunity for companies like Iteris going forward.
Maybe, Joe, if you could talk about some of the important trends that they're driving investment in this market going forward.
Yeah, for sure. So again, as I said, this market's highly fragmented. There are a lot of kind of, marginal market participants today. And yet, the sector is undergoing, what I think is a really exciting and, potentially disruptive period. And that's due to the convergence of kind of multiple reinforcing events. Let's kind of talk about those. So on one hand, you've got the federal government, which is strongly incentivizing state and local agencies to migrate their technology stacks to the cloud. And you may wonder, like, why would the federal government care about that? They're focused on it because they want to facilitate better interagency collaboration. And that means like information exchange and collaboration between the federal government and state and local entities, but also among state and local entities as well, so that we have less of a hodgepodge, and a more kind of seamless transportation infrastructure. They also want to, capture operational efficiencies. And then they're also really interested in mitigating the risk of technology obsolescence, for what's critical national infrastructure. Like obviously, like our road infrastructure is really important to the security of the country. But in addition to the federal government's, focus on trying to get these agencies to move to the cloud, you've also got the emergence of connected and autonomous vehicles, and then associated with that is artificial intelligence. And then also electrification, or the increasing availability of electric vehicles. And all of those things are requiring state and local agencies to modernize their technologies, the technologies that underpin their road infrastructure. So for like an example to kind of help you get your heads around that, there's a general recognition, I think, today on the part of really everybody, that for automated vehicles to achieve level 4 and level 5 automated driving capability, they need to augment their in-vehicle sensors with awareness from infrastructure sensors, because you just can't put enough in-vehicle sensors in a car, especially like at an intersection, for example, to actually have adequate awareness of what's going on at the intersection to navigate that safely and efficiently. So as a result of that, there's various, technology trends in private sector entities, a lot of them very, very powerful, like automotive OEMs and communication service providers, that are also very interested in seeing this transition to the cloud and driving this disruption in the smart mobility infrastructure management market. So let me stop there and see if you have any follow-up questions for me, Jeff, on that point, or if you want to move on.
Sure. Yeah, I guess how do you address, this market in terms of products and services, and so we get a good sense of what it is you guys are actually selling.
Yeah, sure. So as I mentioned, the market's highly fragmented, and you've got a lot of kind of marginal players that have only historically participated in like one category or even one subcategory. We're unique in that we have a fairly broad portfolio. We've always focused on having what we think is the best of breed solutions in key categories in which we want to operate. And as a result, we've ended up with a much broader portfolio than really anybody else in the market. And given, the need that we've seen, for we were moving in this direction, for like at least the last couple of years, and recognizing that, we decided to take all of our technologies and migrate them to the cloud, and basically to create a platform that would facilitate the migration for these agencies from their outdated technology stacks to the cloud. And also we were planned to design that infrastructure in a way that would facilitate that collaboration that I mentioned, which among agencies, which the federal government and state and local agencies are seeking, but also to provide for what's called infrastructure to vehicle communication, which would help with this wave that's eventually coming of connected and automated vehicles. So anyway, that platform, by migrating all of our capabilities to our, this platform or to the cloud, has resulted in the release of, what we call our AI-powered platform that we brand as Clear Mobility. And the Clear Mobility platform utilizes an open API-based architecture. By doing that, we facilitate seamless interoperability among all of our own technologies, and which we then deliver on as software as a service, data as a service, and platform as a service solutions. But also we have our sensors which seamlessly interoperate with these everything as a service capabilities. But again, because it's an open architecture and it's all API based, in addition to the seamless interoperation among our own technologies, it's very easy for third-party technologies to integrate with the platform as well. And so we integrate with various mobility infrastructure data providers. So we ingest data feeds from various third parties. We also integrate with various third-party software products, and then also with third-party IoT devices. And so as a result of that, our Clear Mobility platform is actually really evolving into what we think is a pretty powerful ecosystem, that enables that collaboration that I was talking about, among different agencies, which is particularly important if you've got jurisdictions that abut one another. And so obviously traffic moves across jurisdictional boundaries. That means traffic conditions like congestion is a region-wide issue. And historically, agencies haven't been able to coordinate their infrastructure management. But as adjacent agencies migrate to our platform, we overcome some of those obstacles that prevented that collaboration and allow for more seamless region-wide operation and efficiency. And then also, we become a single nexus point for, private entities, have an interest in understanding the infrastructure on a region-wide basis to integrate with our platform, as opposed to having to integrate with the technology stack of each individual agency. From a functional perspective, because that's all kind of abstract technology, what the Clear Mobility platform is doing is we're really solving a bunch of kind of very vexing mobility infrastructure problems that include, like region-wide congestion, safety on the highway and at intersections, sustainability. Congestion actually is one of the worst contributors to carbon emissions because you get these really long dwell times. So to the extent that we're able to help solve for that, we reduce carbon emissions and improve sustainability. And then another thing that we do is we improve maintainability, of the physical infrastructure as well as the various technologies that are deployed in the infrastructure. We're monitoring them in real time 24/7, and over the air, we can optimize not only our own devices that are deployed in the infrastructure, but third-party devices as well through our cloud. And then again, all that also, enables this idea of infrastructure to vehicle integration or communication, which, as I said before, is critical to unlocking the full potential of level 4 and level 5 autonomy.
So Joe, you guys break out your revenue into products and services. So maybe you could just talk a little bit about what goes into each bucket, what the gross margins are like, within each group, and how you think that trend's going forward.
Yeah, sure. So as I mentioned, we're expecting a revenue at the midpoint of our guidance of about $172.5 million for our current fiscal year, which ends March 31, 2024. That's our fiscal 24 period. Of our total revenue, about $78 million or 45% will be services revenue, and about $94 million or 55% is going to be recognized as product revenue. And about 50% of that services revenue is recognized as non-recurring, and about 50% of it is going to be recognized as annual recurring. The non-recurring revenue is derived from various service lines that include like technology consulting, systems integration, and some traffic engineering activities. Whereas the recurring revenue is derived from our software as a service, data as a service, platform as a service, and managed services solutions. Currently, our blended services gross margin is in the low 30% range, and we've actually have pretty similar gross margins for our non-recurring and our recurring service offers today. Our non-recurring service offers, are people dependent, and so therefore they're exposed to a largely variable cost structure. We do see some opportunities for modest improvement in our non-recurring services gross margins, And we're going to realize that as we continue to build our internal labor capacity. Today, our bookings growth has outpaced our current labor capacity, which is requiring us to use subcontract labor to perform certain activities. And that's impacting, or compressing our non-recurring gross margins. But we're solving for that by adding our labor capacity. But, more interestingly, we anticipate significant gross margin improvement from our recurring services portfolio, and specifically from our software as a service and our data as a service offers. Today, as I mentioned, the gross margins for our recurring services are about the same as our services gross margins. But as we look ahead through 2027, so we have our Vision 2027 that you mentioned, Jeff, which we published a couple of years ago. We're expecting to realize gross margin improvements in the range of 500 to 1,000 basis points each year from our SaaS and our DaaS offers in particular. And how do we get there? The significant improvement in the SaaS and DaaS gross margins is really a function of us having largely fixed costs. Like we have third-party data costs, we have our own, largely fixed costs to process our own data, which we overlay on top of the third-party data to create this very unique curated data set. But again, the cloud infrastructure, the data acquisition, the data processing costs are largely fixed. And then on the other hand, we're expecting, continued significant growth in, those service areas. And so the combination of fast rate of growth and the fixed costs, yields, this substantial operating leverage for those lines of business. And you may be wondering, well, so what makes you so confident, about the rate of growth for those SaaS and DaaS offers? And I'd say it's really a function of what this recent historical rate of growth has been. But also, it's just simply, we're a major player in this market. We've been able, therefore, to make significant investments. And we think that, we offer just substantial feature performance superiority relative to all of our competitors. But also because, even though we're still small, again, we're really big in this market. And we've got a lot of different, service and product offers, which also allows us to bundle our software as a service and data as a service offers with our consulting services and our managed services. And then we also have the ability to attach our SaaS revenue, in particular, to our large installed base of smart sensors. And to give you a sense of the size of that installed base, about 40% of the signalized intersections in the US that are using above ground detection, like advanced sensors, are operating our sensors. So we're at about 80,000 signalized intersections in the US. That may seem like a pretty small number, but there are only like 360 to 400,000 signalized intersections in the whole country. And also I'd note that, we tend to have intersections in like larger urban areas, which represent like the vast majority, of the population and the GDP. So, and GDP is directly associated with mobility infrastructure spending. So we're in all the right locations, and we have the ability to bundle these things together since we've introduced our Clear Mobility platform. But anyway, moving on. So anyway, in any quarter, about 90 to 95% of our product revenue is derived from the sales of our own sensors. And we've got multiple different kinds of sensors, as I mentioned earlier. But we also derive some, like the balance of that revenue, the other 5 to 10% from third-party product sales. And you may wonder, like, why do you have third-party product sales? It's basically, when we're functioning as a systems integrator, we may procure third-party products for our customer, and we'll manage the installation and the implementation of that technology. And then there are other instances where agencies will buy our sensors, and there'll be like associated third-party technology which gets pulled through with those purchases. So again, about 5 to 10% of our product revenue comes from these third-party products. Anyway, the margins for our sensor portfolio, these are our own products, is in the high 40% range. But the margin for the third-party products is low. There's usually a limit, kind of sometimes it's statutory limitation in terms of how much markup you can put on those products. And so it tends to be 10% or below. So that yields a blended product gross margin today in the mid 40% range. with some fluctuation, within that range, really just due to product mix, which is going to be different from quarter to quarter. Anyway, looking ahead, there's not much we can do about the third-party product gross margins, but our own gross margins, we expect to continue to improve. There's obviously a ceiling, but we're taking various actions to improve our efficiency. As we continue to grow, we get more purchasing power from the electronics components providers from whom we're sourcing different technologies. And so we would still expect to be able to eke out some additional gross margin improvement on our own sensors, which will overall improve our product gross margin.
So maybe you could talk a little bit about, the supply chain crunch, how that affected product gross margins, and how you guys dealt with that, what your strategy was there.
Yeah, sure. So I got a lot of gray hair during the period. That was a nightmare, as it was for, many, many companies. But anyway, so beginning in the December 31, 2021 period, we started to experience some severe shortages of certain electronics components, again, like other people did. And, obviously our smart sensors, have a lot of exposure to those components. Like most of our sensors are actually, think of them, we've got actually sensors, I'm sure video and radar and Wi-Fi sensors, which are monitoring what's going on in the environment, especially at intersections, but along arterial corridors and even on highways. And then we digitize that information. We're processing it locally because it's really a system that we're deploying. And we also bring that data back to the cloud. But anyway, those systems that we're running locally, have very sophisticated circuit boards, and typically they're anywhere from like 80 to 120 electronics components on any individual circuit board. So, this global supply chain issues were a big deal for us. As we also had contracts, that we needed to deliver against, but most importantly, we have really great customer relationships and high customer stickiness because we're all about making our customers successful. So we made a strategic decision to go into the market and procure as many components in the broker market as we could, even if it was highly inflated prices, in order to be able to continue to service our customers during that period. The downside that led to extraordinary purchase price variance during the period, and then that drove decreases in our sensor gross margins for a few quarters, and also as Jeff, it created some short-term liquidity pressure. So anyway, recognizing that was going to be a challenge, we put together a supply chain improvement program. I think we were very transparent with our investors about specifically what we're going to do, how long we thought it would take to get through that period, and I think we delivered right on schedule. There were various elements to that plan, but one of the things that we did is we intentionally qualified alternative electronics components on all of our primary circuit boards. And previously we hadn't done that because, being relatively small, we'd elected to focus on like a single, what we thought was sort of the best component for each. There are many of them on each individual circuit board, but we really were focusing on trying to standardize on like a single provider, a small set of providers. But anyway, given the circumstance, we had to diversify. And that started to yield tangible improvements for us in the December 31, 22 period. And I'd say that was actually ahead of most of the participants in our sector, some of whom are only now really beginning to get on the other side of their own supply chain issues. And as a result of getting through that, pretty quickly, it enabled us to take significant market share during the period. And then also on a go-forward basis, we believe it's improving our component sourcing capability. But anyway, beginning in the June 30, 2023 period, our supply chain dynamics fully returned to normal. And the company since then has been, reporting consistent profitability and positive net cash flow. So as a result, through our fiscal 2024 first 3 quarters or 9 months ending December 31, 2023, we reported record revenue, which is up 14% year over year. It's all organic. We didn't do any acquisitions, obviously, during this period. And then also our adjusted EBITDA for the first 9 months was $10 million, which is an $18.1 million improvement year over year. So I think the point is that, we got through a really difficult period. We actually enhanced customer loyalty, took market share, which we'll continue to capitalize on going forward. And some of the actions, which frankly we were forced to take, we might not have been smart enough or pressured to do it, but it will continue to benefit us going forward.
Okay. Joe, maybe you could talk a little bit about your customers, both on the public agency side and on that side of the house, how the sort of federal programs are influencing that, and then also maybe talk a little bit about your private customers and what types of applications you see available on that side.
Yeah, for sure. So the public sector, which represents like 95 to 90% of our revenue today, is largely made up. We do some work for the federal government, which is, in our opinion, highly strategic. But for the most part, most of our customers are state and local agencies, and overall the public sector environment is surprisingly really healthy. And it's largely due to the factors that I talked about earlier. There's just generally been pressure from the federal government to modernize the mobility infrastructure technology stack. And then also there are these trends like electrification and connected and automated vehicles and AI. And so that's also creating this disruptive environment and a lot of investment. And frankly, it's like reallocation of existing budget towards these technology forward areas. On top of that, however, I think a lot of you guys, I'm sure, are familiar that federal government, Congress passed the Infrastructure Investment and Jobs Act in November of 2021. And then that was almost immediately signed by President Biden and went into effect, I think, on November 11th. And that provides $1.2 trillion in federal funding for infrastructure investments for over a 5-year period. About half of that, 1.2 trillion, was directed to the U.S. Department of Transportation. The majority of that, 600 billion, is further directed or designated for highway and arterial road improvement investments, meaning that that's the area that we've historically competed in. And so we've seen basically the federal investment in this sector is doubling over this 5-year period. I will say that the states have not been able to put all that money to work, as fast as the federal government had assumed. Because I think the federal government thought, well, if we just give the states that money, they'll be able to utilize it immediately. But of course, they couldn't basically double their workforce in order to, put all of that money to good use. And so, a lot of it's sort of piling up in their bank accounts. We are starting to see an increase in state and local spending, but it hasn't been impacted as much as people had thought immediately. The good news is that that's just going to extend the tail, because as long as the state and local agencies obligate those funds before the IIJA legislation expires in 2026, they'll be able to continue to spend that money indefinitely. So we would expect to see a benefit from that for at least another five years. With respect to private sector opportunities, we're seeing and by the way, when 3 years ago, we did about 0% of our revenue was from private sector entities. And today it's about 6 to 8% of revenue. And we see that just continuing to grow, as we look ahead. But anyway, we're seeing an interest from various private sector entities because they want to get access to mobility infrastructure data, in order to improve their own decision making and their own operational efficiency. It's like to help people understand, like, well, why would some of these private sector entities care about that? Let me try to put that in context. So, like some of our customers include like insurance companies, and they're interested in using mobility in infrastructure data to contextualize the risk scoring that they're doing for policyholders, who have premiums based on individual driving behavior. And so like we're able to put like the rate of like speed of that vehicle, hard braking, hard acceleration moves that those drivers are taking in the context of other travelers and road conditions, which can vary from day to day. And so that yields like a lot better risk scoring and uplift for insurance companies. And so that's like a very exciting new area for us. Additionally, like mapping technology and even media companies such as like iHeartMedia, they're really interested in mobility infrastructure data, specifically like event data, such as road closures, for example, so that they can better differentiate their services. And then last mile delivery and logistics providers, they're also interested in mobility infrastructure data, like more specific, like signal phase and timing data, because that allows them to better optimize route planning decisions. So again, more and more we're seeing, these private sector entities interested in this data. But additionally, like as I mentioned, there's the emergence of connected and automated vehicles. And so we think that's going to create future new revenue streams from various private sector entities. And we're starting to release and begin to monetize various connected vehicle applications. And these applications include things like freight signal prioritization, curve speed warning, and like pedestrian safety alerts. And, in the, like, to help you guys understand, like, well, who would care about that? Like the logical economic buyers for those kinds of applications would be delivery and logistics companies, mapping technology companies, but also automotive OEMs and tier one parts suppliers. We envision a day where we're going to be able to provide information. Well, actually, we're already doing this. We have pilots that are active pilots going on today, where we're sensing what's happening in intersection and then sending an alert, which is being displayed, to the driver in a car, making them aware of the fact there's a pedestrian, entering a crosswalk. And that alert's triggered when that driver, for example, turns on like the right blinker, signaling they're going to turn right, and then they get the notice about the pedestrian. So, all those various applications you think will drive additional private sector revenue going forward.
So maybe you talk a little bit about the progression of deal sizes, as time has gone by. I know you guys have some pretty big deals in the pipeline. So maybe talk about, the customers for those and, why those have gotten bigger over time.
Yeah, sure. Well, it goes back to the fact that, we embarked on this platform strategy, a couple years ago. And so that's enabled us to evolve from being, like a provider of, like a portfolio point solutions, which by definition are relatively small, to being like a much larger solution provider. And that's primarily driving like the increase in the deal size. And so, like when I started at the company, like the average new task order was like, like $80,000, and today it still isn't as big as we'd like, but it's several $100,000. And to your point, Jeff, increasingly we have, contracts that are valued at, 5, 10, 15 million and beyond. And we expect, to continue to see that. Actually, I like having a blend, right? I mean, I don't want to be like overly exposed to like a small number of deals, but there's obviously like strategic, financial, operational benefit to having a sizable portfolio of these very large multi-year contracts, which increase like predictability and operational efficiency for the company, and we expect to see that continue.
Got it. On the earnings call last week, you mentioned you thought bookings were going to be pretty good in the March and June quarters. Maybe talk a little bit about like the visibility that you're seeing and how that's going to impact kind of your, your bookings?
Yeah, sure. So, I mean, bookings are always unpredictable. We actually had pretty steady bookings results for the last, 5 or 6 quarters. We did see, bookings were a little bit slower. They were light, relatively speaking, in the December 31 period for us. But that was due to the fact that a couple large orders, which we'd expected to close in the December 31 period, pushed to the right. And as I said on the earnings call, like, we subsequently received a notice of intent to award the first week in February, just a few days ahead of our earnings call, that was valued, that particular order is valued at about $10 million. So, as a result of just our overall pipeline and pipeline visibility, and then some of these things which got pushed to the right, we're feeling very confident about our fourth quarter, our March 31 and June 30 bookings. But the way to look at it, like, more, I think more sort of like systemically, and to kind of think about, like, beyond like this near-term movement that we've seen, what is our expectation going forward, I think, is really to look at our pipeline growth, which has been enormous, and we disclosed that on our most recent earnings call. So today, our qualified sales pipeline has reached a historic high of $650 million, which represents about a 20 to 25% increase, against what our qualified sales pipeline was the same time last year. At the same time that our pipeline growth has been excellent, we've actually seen an improvement in our competitive win rate, which historically has been kind of in the low 50% range, about 52 to 54%. And I don't want you guys to think that that means, like, well, it's a coin flip, we may or may not win the deal. In the competitive deals, like, there's typically at least 3 competitors and often 5. And so to have, like, even our historic win rate of 52 to 54% was excellent. But it's currently on a trailing 12-month basis, it's averaging 66 to 67%, which is fantastic. So the combination of the total pipeline growth and the improvement in our win rate, which I think is directly attributable to our platform strategy and the market's favorable response to that, gives us a lot of confidence going forward that we're going to capture a disproportionate share of this growth and spending in this sector.
Gotcha. For the maybe you could talk a little bit about the 2027 plan you guys have in place, where you expect revenues and margins to go from here.
Yeah, sure. So in fiscal 2022, we outlined this 5-year target operating model, and we've been referring to that as Vision 2027. The Vision 2027 targets include total annual revenue in the range of $245 million to $265 million, which assumes 13.6% revenue CAGR, for the period. And then also EBITDA margins in the range of 16 to 19%. Sorry about that. And as a point of reference, our current EBITDA guidance is a range of 7 to 9%. So let's say 8% at the midpoint. So that's a substantial improvement over the next 3 years. Additionally, we expect the composition of our total revenue to change. Specifically, expect annual recurring revenue to grow from about 25% of total revenue to about 30% of total revenue over that 5-year period. And that implies that ARR is growing at about twice the rate of our non-recurring revenue streams. And to help explain the EBITDA margin improvement, the growth in our ARR and, the associated cost leverage that I talked about. Remember that our SaaS and DaaS products in particular have largely fixed costs. That drives a lot of the margin expansion and the absolute increase in EBITDA margins or EBITDA dollars. I guess I would also say too, just as a point of reference, that as we get closer to 2027, we don't do this today, but we'd probably expect to break out our SaaS and DaaS products in a distinct reporting segment as we get closer to 2027. So we have better visibility to that. But anyway, at this point, we don't do that. But in addition to the improvement, on our SaaS and DaaS service lines, we're also just generally going to benefit from economies of scale really across all of our service and product lines. And that's due to some of the things that I mentioned earlier. It's improvement in the labor capacity, which is going to benefit our consulting services, some of the supply chain, and then other manufacturing efficiencies that we're realizing, and then just general improvement in overhead absorption. So again, that on a total enterprise basis, our expectation is that our EBITDA margins are going to improve from the midpoint of our current guidance range of about 8% to 16 to 19% over the next 3 years.
Terrific. Joe, there are a couple questions in the chat. I guess one of them, which we covered a little bit, but how are you selling the SaaS products today, and what types of customers have been the primary adopters so far? Public agencies versus private sector.
Okay. So we have sort of different sales models for like different kinds of sort of areas of our portfolio. So I appreciate the fact you asked a question specifically about SaaS, because it's slightly different than the way we sell, our consulting and managed services, and still different from our products. But with respect to our SaaS and our DaaS products, we have kind of a traditional enterprise sales structure or software sales structure, which includes enterprise field sales reps, which are supported by an inside sales team. And then we're also building out our customer success function, which is responsible once we close an account for attaching additional SaaS and DaaS offers, trying to migrate people up the price curve, and then also is responsible largely for our renewals, which tend to be about 100%. In terms of the split between private and public, actually, virtually all of the private sector revenue that I mentioned, about 6 to 8% of our total revenue, is SaaS and DaaS. What that implies is that more than 50% of our total SaaS revenue is actually coming from private sector entities. But we're seeing really strong demand in both the private and the public sector. And we would expect, that level of demand to remain consistent, if not even grow, over the 2027 period for, some of the reasons I talked about previously.
So what do you think your target is? You said you're looking to break out the SaaS revenues at some point. Maybe just tell how you're thinking about that. At what revenue level or what percentage, you guys are going to start breaking that out.
Yeah, so I guess I don't want to answer it exactly that way, because I feel like I'd be sort of giving like explicit guidance, for what our, kind of already creating that segment by saying, well, we're going to do it in this year when we reach this target. But I would say that I think we would, we are looking at probably doing that in our fiscal 2026. And so as a point of reference, our fiscal 25 begins on April 1st of this year. It ends on March 31 of calendar 2025. And so our fiscal 26 would begin a year from April 1. And that's probably when we would look to, create that distinct segment.
Okay. Great. I guess if there are any other, people have any other questions, please put them in, in the chat. So Joe, maybe you could, sort of finish it off by saying what excites you the most, about your business today, and also, what thoughts you'd like to leave, participants on this call with.
Yeah, sure. Well, I think that we're in a really unique sector in that, there's a lot of investment and exciting technology events that, are creating, as I said, I think a unique sort of disruptive environment, and that we're in a great position to try to capitalize on that. At the same time, like we're not like strictly a startup, right? We have a very solid foundation, and also to some degree, our sector historically, but especially with this IIJ funding, is arguably somewhat counter-cyclical or protected from, not that people are necessarily forecasting it now, but from any sort of adverse broader economic event. So I think it's a unique situation where there's a lot of upside and there's not much downside, or there's certainly downside protection because of the unique characteristics. And then again, it's an incredibly large market. It is highly fragmented, but there's a tremendous opportunity for both organic growth and inorganic growth, which we haven't talked about yet on this call. But we definitely see a pathway to emerge as a very substantial player in this large, highly fragmented market that's undergoing some really exciting, structural change.
Gotcha. Okay. Here's another question from the chat. Are you guys selling any traffic data to car companies that are piloting autonomous vehicles?
Yes, we are. Yeah, as I mentioned, we've got active pilots going on, where we're demonstrating the benefit of infrastructure to vehicle integration, but additionally, either directly or indirectly from some of our mapping technology partner relationships, most of the traffic flow and event data that you're receiving if you're using in-vehicle navigation in virtually any car manufacturer in the US is ultimately being sourced from us. Now, if you're using Apple CarPlay, or Google Maps, just to be clear, that data is coming from them. But if you're using in-vehicle navigation, virtually all the flow and event data that you're seeing when you're using in-vehicle navigation is coming from us. And that's, a critical enabler for every automotive OEM's autonomous driving, roadmap. So we're connected in two ways. One, we're actively doing pilots where we're facilitating infrastructure vehicle communication at the edge. And then we're also through our cloud, we're publishing, again, the flow and event data, which is also a critical element of every automotive OEM's AV strategy.
Gotcha. Okay. Here's another, I'm not sure.
And I also would mention too, sorry about that, but we briefly
talked
on our last call that we're also doing the North American ITS strategy for Toyota. And, an element of that is their AV strategy in North America. So I just wanted to mention that as well.
Sure. Another question, how much in federal spending from the IRA bill is included in the $650 million sales pipeline? Not sure you're gonna be able to differentiate exactly.
Yeah, that's a huge problem. So when also the IRA's Infrastructure Reduction Act, which is more focused on internet availability, and there is certainly vehicle electrification in there. We don't have direct exposure to that, although it's definitely indirect benefit. What we're really more focused on is the IIJA, which is like a separate piece of investment. But to Jeff's point, which is true for both the IRA and the IIJA, but especially for the IIJA, which I know better, most of the funding, 99% of that comes from formula funding. And formula funding is fungible and gets intermixed with state and local revenue sources. So it's impossible to draw a straight line and say, hey, this particular opportunity is directly or even partially funded by IIJA. But we can assume that today, the vast majority of every opportunity that we're pursuing is benefiting at some level from the IIJA. Historically, the federal government, as a point of reference, contributes about 20% of the total infrastructure spending nationally. So if you look at the state transportation budget for, let's say, the state of California, 20% of that's coming from the federal government. So virtually any work that we're doing would have some contribution from the federal government. Where you can more directly draw that line is with respect to some of these discretionary or competitive grants, which have been awarded. And Jeff, I think, is getting to this point. Once the USDOT awards those grants, they then need to go through a very lengthy process to obligate those funds. And typically, we're finding it can take as much as a year to 2 and even 3 years before those funds get obligated. So we're not seeing that show up yet. We actually have won some of those, and we've received that funding, but it's not a lot yet. So anyway, the whole point of it, it's hard to draw a direct line between the IIJA and individual task orders that we've received.
Got it. Okay. Joe, well, very good. This has been very elucidating conversation about the company. Hope everybody on the call has learned something. I probably picked up some facts as well. But Joe, really appreciate your time today. And I'm sure, if anyone on the call has additional questions, I know Joe's been always very accessible to me when I have questions. So I'm sure they'd be happy for you guys to reach out to them as well.
For sure. Yeah. And thanks a lot for inviting me, Jeff. And I appreciate everybody taking time to come listen to our story. And as Jeff said, we would be more than happy to talk to any of you. Feel free to reach out, directly to me or to Todd or through Jeff or Todd Curley, who does investor relations for us. And, we're happy to jump on a call anytime.
Great. Thanks so much, Joe. Thanks, everybody.